Punita, we just heard the governor explain the rationale of his decision. But how do you think the corporate sector in particular is going to respond to this? Will they see it as a positive, or will it be just, nothing very much to talk home?
Well, I think there are two aspects that the corporate sector is sort of under pressure on. One is that the demand side is weak, and second is that the investment isn't happening as expected. So interest rates cuts can only stimulate demand on the margin, but they really are not going to affect the investment cycle at the moment, because I think what the problem there is that the banks are not lending or willing to lend to the companies that are in this sector, which is that are investment oriented, because most of these are the ones that have become NPAs. So the NPA problem is the bigger issue why investment led growth isn't happening, because banks are refusing to lend. Even now, if you speak to banks, despite some of the reforms that have happened in the power sector, they are saying we don't want to lend to the power sector because we think that they've bid too high for some of the coal blocks. Similarly, if you talk about banks lending to infra projects, they are having issues there too, because they feel that those projects are not really getting funded or not taking off, or they still have receivables, so they don't want to lend. So whether an interest rate cut happens or not, that problem is not going to change. And I think that is a different problem, and therefore the investment cycle will only have a marginal impact whether interest rate was cut 25 bips or 50 bips. It's the demand side that might be somewhat positively impacted. So I don't think this is going to really impact corporate earnings that much. Basically, the ball is still back with the government to really handle some of these issues, and the banks to really figure out a way in which they can transmit lower rates and also increase credit and in lending, in fact.
Pradeep, are you disappointed that the Reserve Bank still seems so fixated on marginal cost of funding, and despite that everything that banks have tried to say, the Reserve Bank just doesn't seem to get it?
I think the Reserve Bank governor doesn't seem to listen to you also, because what you said in the beginning of this show,
I don't count.
that the governor is fixated on marginal cost of funding. I agree fully with you. I fully agree with you that I think marginal cost of funding is not the way to go ahead. We have to look at the entire cost of funding. Banks I think 95% of the bank's liabilities are deposits, and deposits are at fixed rates. It's not at floating rates. So we have no way we can go to a marginal cost of funding for computing the base rates. I think the governor has to relook at this thought.
Nilesh, one key point that he made was that the RBI continues to be data dependent. There are too many uncertainties. He's increasingly sounding like the Fed right now, with no hints being given out at what could happen in the next policy or over the next 3 months.
Yes, but that's true of any central bank. They have to look at the data and then take the decision. And clearly, by taking a 25 basis point rate cut in line with market expectation, RBI at least has shown their positive inclination towards lowering interest rate if data permits them. And while throughout the conference, he has mentioned that look, we will look at the data. If monsoon is good, if oil prices don't go up, if government is able to debottleneck the economy, and whenever we get an opportunity, we won't deviate from the disinflationary path. But whenever we get opportunity, whenever we get room, we'll try to lower interest rates. So I think that's a fair statement, and that is what market is expecting from the regulator. Look at the data and take the decision which is in the best interest of everyone, the country, the borrowers, the lenders, the banks, the investors.
As investors in the markets, we look ahead and take a leap of faith on whether the earnings will recover or not. And we basically model out, and we don't look at the current data. But they always say that the stock markets lead and the economy lags, and the economists tend to lag. So from that perspective, the RBI is acting, I guess, more as an economist, a macroeconomist, who is lagging or looking at the data, whereas stock market investors are looking to sort of take a leap of faith. So should a central bank also similarly take a leap of faith? I don't know. I don't know the answer, but potentially if they did, then that might give a more positive commentary. But the commentary today is very much, let's look at the data and let's react to the data. And that's remarkably consistent for the RBI, and the governor hasn't changed his stance. He is conservative. as he himself said, that I'm neither conservative nor aggressive, but I think he is conservative. But that's at least consistent, and he's not giving handouts. At least one can say he's not succumbing to a lot of pressure and giving handouts and making it easy for the banks to get out of this mess. He's really keeping the leash and making sure that the system cleanses out, and so one has to give him credit for not succumbing to pressure. But can he take a leap of faith? I guess maybe he could. At least the investors, as investors, we do.
Well, Jayesh, I'd like to get you in on that. Should the RBI take that leap of faith, or should it go ahead looking at the rear view window?
No, I think as Punita just said, right, whether it's conservative stance or an aggressive, I think the central bank generally has to be a little bit conservative, right, because, but highlighting, if I really look at it, highlighting a lot of all the negatives, but in the meantime, if you really look at it, it's highlighting the negatives, but it's also saying that we are open to both sides. So to that extent, definitely there's no point for a central bank to precurse the market like an investor, whether it's fixed income or equities. Of course, their job is to always take a little leap of faith and take a chance rather than actually event to happen at that particular point of time.
Well, Punita, let me come back to you and ask you, the policies clearly spoke about the fact that investment is weak, demand is weak, we're growing below potential. So given all that, would you not think there's a case for something more aggressive from the part of the Reserve Bank of India?
Well, it depends on their mandate. If they believe their mandate is, and they're saying that their mandate is really to do inflation targeting, then from that perspective, you couldn't expect anything different, because we don't know what CPI is going to do.
Let me get in one more guest in this discussion, Ritika Vankar Mukherjee, Associate Vice President, Economist, Institutional Equities at Ambit Capital. Ritika, good having you. Thanks for joining in. We've got, well, it's been, 55 minutes since the first comments from the Reserve Bank are out. What have you made of, more importantly, the commentary? The action was anyways on expected lines.
Right, you're absolutely right. I mean, what they did was really consensus expectations. But I think where we think we got it really right was in the sense that the RBI has begun to tend towards our own growth forecast, which is a very pessimistic 7% for FY16. Moreover, the RBI also increased its inflation forecast, which is bang in line with what we had been highlighting, that look, headline inflation is going to tend downwards till about August. But from there on, there's a very real risk that headline inflation will start tending to 6% by Q4 FY16. So I think from that perspective, a lot of this we had expected in terms of the commentary, that the Reserve Bank of India has started guiding to lower growth for FY16, significantly below what the government is clearly saying, and also I think a little lower than what consensus is saying. Simultaneously is flagging the fact that headline inflation is going to pick up in the second half. So really the worst combination of a GDP downgrade and inflation picking up in the future.
But there have been a number of comments that have come in recently from economists at large which speak about how there is a natural necessity for the rupee to depreciate for Indian exports to become a bit more competitive as well compared to the rest of the world. Do you find water in that argument, and do you think the RBI is unduly bothered about that at all?
I don't think so, because if you really look at it, that stance has been only to control volatility, and they have been doing that. Of course, they have been also building up aggressive reserves, which is good. In terms of, yes, we always had this argument even when rupee was at 42, even when, right now at 63.80, we still compare that, okay, rupee needs to depreciate further for exports to really grow. I think that's always been the case, but if you really look at all levels, our exports not really suffered much dramatically. Of course, at this juncture, there is a global currency war happening, and if it depreciates along with the rest of the things, I think RBI would not really be, putting a big stopper on that situation at this point of time. I think also looking at the overall theme of this thing, right? So, I just was trying to wonder, like, it's definitely on the expected lines, rate cut with a lot of, caution, a lot of hawkishness. But if you really look at each one of the cautions that they have raised, right, There is also, I would say, there is a lot of upside positivity which can really happen. If you look at monsoon, they have said monsoon with government policy, and there is no reason for people to doubt that government will not really, manage the food inflation. They have done it last year. They will definitely do it next year too.
Jahangir, more importantly, do you think this overcautious stance of the RBI will impact GDP growth?
You can't have it both ways. You can't say that growth is going at 7.5% because that's what my CSO number says, and then you keep on saying that India is growing faster than China and is the fastest growing one of the fastest growing economy in the world, and at the same time say, when really, as far as monetary policy is concerned, we don't really buy those growth numbers. So you have to choose between the two of them. Either India is the fastest growing country in the region, or India isn't the fastest growing country in the region and requires monetary policy to support it. My sense is that we are caught in that quandary. If you look at just the inflation numbers, yes, WPI inflation has turned negative. WPI inflation in China has turned even more negative. Therefore, even though we are deflating at a less pace than China, and therefore argument would be that India needs to cut rates in order for their economy to be boosted. What one is forgetting in all of this is that in February 20th, the RBI and the Ministry of Finance signed an MOU which said that RBI's only objective is inflation targeting. And RBI's performance will be tested whether or not it manages to reach 6% inflation in January of 2016, and thereafter keep inflation to 4% with a plus minus 2% band from 2016 and 17. That's the only objective by which we should judge the RBI. And therefore, RBI's entire policy framework needs to be judged whether or not it can bring down inflation to 4% or not. Growth no longer is a criteria or an objective in the RBI's objectives for running monetary policy.
But Maithili, before you take in further questions to Punita, to Jayesh, I'll probably have a question for Punita as well. I just want to get a sense from you as well. Your earlier interactions with the RBI governor as well, and you've made it you've kind of spoken about this too, that he's been a bit reluctant in moving away from what his grail is, and that is as an inflation warrior. And do you think this time around too, he's kind of stuck to that? Because he did make a comment that he has erred on the side of getting investments in. It kind of seemed that he was not really wanting to do that, but he's trying to do it to show that he and the government are working in tandem to get investments in.
Yes, I would think so. See, let's accept that every central banker starts off really as being an inflation hawk. Whether he says it explicitly or implicitly, that does remain that price stability is a primary objective. But having said that, central banks, particularly after the global financial crisis, and always in India, have had a 360-degree look, where they look at not only at price stability, but also at growth, also at employment, bank supervision, financial stability, a whole host of things. So I think the problem, as Jahangir very clearly and very well put it, was that the monetary policy framework agreement really doesn't give him any cushion at all. It insists that the RBI is squarely responsible for price stability. Now, when you box the RBI in like that, then whatever inflationary hawkish tendencies any central bank governor might have, those tend to get aggravated. So I think that really is a problem. The monetary policy framework agreement, I think, is something that he should never have gone in for the simple reason that inflation targeting is something that's been tried, tested, and now junked all over the world. So I think this is really a mistake. In India, very often we copy the West after the West has tried it and junked it. We try that with capital convertibility. We're trying it now with inflation targeting. I think we really need to move with the times and not reinvent the wheel. So I think this really is a part of the problem that is now we're seeing, that the RBI is so fixated on price stability that they don't look at growth, they don't look at export performance, because they know that when it comes to price stability, the governor is answerable. So you want to play safe. So I think the problem really is of having gone into a monetary policy framework agreement which has both pluses and minuses, and at this particular juncture perhaps has more minuses than pluses.